It's time for the Phil Ferguson Show, only on Secular Media Network.
Well, hello, everybody. This is Phil Ferguson, and you are listening to The Phil Ferguson Show. This is show number 168, and we have a lot to go over today. A little bit later on, we are going to talk about how to beat your child like a good Christian. We're also going to talk about the Ark, Ken Ham's monument to human stupidity. So we have a lot to cover. But before we get to that, we're going to have an investing skeptically topic today. And that topic is all about how to use the cushion and how to pull out money and how all of that works in retirement. Of course, I welcome your email, and I get quite a few of them now. And you can contact me, phil@polarisfinancialplanning.com. They cover a wide range of topics, but for whatever reason, in the last week or two, and quite a few times I was asked while I was in California, exactly how does this cushion thing work? We've talked about this before, and the cushion is the part of your portfolio that is invested relatively conservatively to quite conservatively to protect your assets when you are in or close to retirement. My regular listeners know, of course, that you want to try to avoid selling low and buying high. You're all in the U.S. stock market, and you're living off of your portfolio. There will be at some point in time a market correction, a market drop, a market dip, a market crash, whatever words you want to use. It means the U.S. stock market, or markets in general, if you have international investments, went down, and went down more than a couple percentage points. So if we have a situation like 2008, where the U.S. stock market went down 37%, if at all possible, you would rather not sell stocks that just went down 37%. Of course, 2008 is not the only time. We had this in the late 90s. We had this in the early 90s. Every so often, there is a significant market correction. Sometimes it's 1 or 2 years that go down. Sometimes it's one really big year that goes down. There's no way to know when it will happen next. At least that's my philosophy. Other people think they can make these predictions. I think they're full of shit. The way I try to design people's portfolios, they should be safe in either case. So I'm going to go through an example, theoretical scenario, using actual data from the last 10 years. Now keep in mind that this is hypothetical. This is theoretical. I mean, even though the data is going to be real, this doesn't represent an actual person. This doesn't represent an actual example of what did happen. I'm looking backwards in time with the full knowledge of what has happened. So there is the potential that I cheat. There is the potential that I pick and choose numbers based on knowledge that I have of what's going to happen. And that is a very severe limitation, and I want to make sure that you understand that going forward. This is just to demonstrate how it could work. Can it work this well? Maybe. Did I accidentally, unintentionally pick options and choices that made it look better? Maybe. I'm human. That's a problem with this. So I wanted to make sure that I was completely upfront that this does not represent anything that actually happened to anybody, and that I, as a human, have the possibility of picking things that make me look better. So with all of that said, what we're going to talk about is a person that has $1 million portfolio and needs $50,000 out of this portfolio every year to pay their bills. It could be a person that only needs $50,000, and that's their budget, or it could be a person that more typically might be a couple, and they both have some Social Security. Maybe one of them gets 25 to 30, and the other one gets 10 to 15, maybe 20. And so their total budget could be $100,000, but from their investments, they need $50,000. So we're going forward on that. If that is not your situation, I understand. Every situation is different and unique, and you could kind of, in your head, adjust this up or down. So if you need $200,000 from your 100,000 a year from your portfolio in retirement, think of starting with $2 million. One of my general rule of thumbs is that you can take out 5% a year, and odds are you will outlive your money. So, of course, no guarantees. If the market goes down 20% for 5 years in a row, well, then we're probably all screwed, so it's not going to matter. But it's not going to work in that case. I'm doing this based on the patterns and the trends that have happened over the last 50, 100, and even 200 years, keeping in mind always that data over 100 years old, at least for the U.S. stock market, starts to get a little sketchy. So, we've got to keep that in mind. So we have a starting position at the very beginning of 2006 of $1 million. Now, I set up this portfolio to be about 45% in the U.S. stock market, about 25% in real estate investment trusts, the total stock market, international stock market, emerging markets, and a concentration in Europe. The reason I did that is because back in 2006, I was very optimistic on the euro and its ability to bring down barriers to trade between European countries, European countries and European companies, and we should get results in that in those investments. Whether that works or not, we'll find out, but we had that. In the part that's the U.S. stock market, what I currently do is a little different than what I did 10 years ago, so I tried to take that into account. Again, with hindsight knowledge, it's always risky to look back this way. If you have a large enough portfolio, I break up the stock market into 6 segments. I call it the U.S. market matrix, and it's large cap growth and value, mid cap growth and value, small cap growth and value. All 6 of those positions tend to make about 10% per year in the long run. But in the short run, they can fluctuate between each other. And when I say short run, for me, that means 3 to 5 years. It is not necessarily daily, monthly, or even annually. I don't think you should be making adjustments that quickly, that often. It can be counterproductive, and when the market goes down, it can be very upsetting. And for the bond portion of this portfolio, again, at the starting point, I have a wide mix of cash, short-term bonds, intermediate-term bonds, long-term bonds, high-yield corporate bonds, also known as junk bonds, and Ginnie Maes, which are based in real estate. And, of course, a note for the regular listener, you know that at this time in 2016, I do not recommend any money in intermediate or long-term bonds for reasons I've discussed in previous shows, and I'm sure we'll go over it again, but I don't want to belabor that point too much now. But back in 2006, these bond funds were paying really generous interest rates, which they are not today, and they were at, temporal highs, not the highest ever, but, pretty high on the spectrum from what they've been for the previous years. So I was much more optimistic on them and had them as a part of the portfolio. So what I'll do is then give you the results for a year and then tell you how one could take out the $50,000. I'm not going to do this for all 10 years because that would be incredibly tedious and boring. But I want to do the first couple of years in particular because in 2008 the market went down. And to kind of show you how this would work. So in 2006, the total stock market return as measured by the Wilshire 5000, which is a representative example of the total stock market, the U.S. stock market only, it went up 15.88. The portfolio that I created that had 30% bonds, 25% real estate and international, and then 45% U.S. stock market went up 15.86. Virtually the same return, and that's because the U.S. did well, international did better, REITs did great. That was in the housing boom, remember? And the bonds pulled down a little bit, but did pretty well still. And so at the end of the year, your portfolio had grown from 1 million to 1.58 million. I'm going to round to try to keep the numbers simple. And so at the end of the year, when you have to pull out your 50,000, you can pull some out of the bonds because they grew. And the point of the cushion is to not grow, but to be a safety net when the market goes down. Also decided to pull out a big chunk from the Vanguard value, large cap value position, because in that year, the value position went up 22% when growth went up 9%. So there's one of those unusual fluctuations where it changed year to year. And so we take out the 50,000, and then we look at what we're going to do for 2007. In this case, I decided to make no changes to the mix other than the money I'd just taken out. And we start with 1.1 million, which is 50,000 less than what we had at the end of the year. It's actually 1.108 million. And we let that roll forward. The U.S. stock market went up 5.73%. The portfolio amazingly beat that, and it went up 8.45%. So this is one of those rare cases that a highly diversified portfolio beat the U.S. market, in part because the U.S. market didn't do particularly well. And ironically, the position that did the least well was large cap value. That was the one we just took a bunch of money out of because it did really, really well the previous year. So the end result is the portfolio went up 8.45%. We now have 1.202 million, 1,202,000. And again, we take out our 50,000. This time, I decided to take out the 50,000 from the bonds. Again, a total of 14,000 from bonds because they were up. So we want to keep the bond portfolio at about 300,000 for this scenario. We can do different for you depending on your situation. And since international now had done really well and definitely beat the U.S. market, we don't want to take too much money out of the U.S. market. We'll take it out of where we made the most money. And the position that went up the most was the emerging markets position. It went up 40%, even though the U.S. market was up only 5%. So this is volatility. Sometimes a position will lose money. Sometimes it will make a whole lot of money. This year, it happened to make 40% when the U.S. market made 5%. So that's where we scraped the cream off the top. So we took up 11,000 out of that, and we also took 17,000 out of total international because it had 2 years of great growth, and it was kind of getting out of proportion. So this is how you do the rebalancing. When you're investing and not taking money out, you might have to sell something, or when you're adding money, you try to add it to where you need to keep your balance. In this case, we're taking money out to keep the balance. And so again, we take out the money, and at the start of 2008, which we all know now is the terrible year, we have 1.152 million, which was the result from the previous year, minus 50,000. And in this year, the U.S. stock market loses 37.34% as measured by the Wilshire 5000. The portfolio, in part because it's got a third of it, I guess, maybe a quarter of it in bonds, only lost, and I say only lost 30%. So you lost 30% instead of 37,000. And this is where, philosophically, I can have a material disagreement between investors and possibly other advisors. Because you still had 70% of your money in things that are relatively volatile, you experienced the vast majority of the market drop. You did. It's awful. Losing 30% is not good. Now, because the stocks, U.S. stocks, international stocks, real estate, all these things were still there and they went down a lot, we don't want to sell those. This is where the cushion really comes into play, and we took all $50,000 out of the cushion. And we took it from different bond funds depending on how they did. Some did better than others, and the ones that did better, we take out a larger chunk. So all 50,000 comes out. Now, because the portfolio went down and you still took out your 50 grand, maybe in your scenario you could take out something less in a really bad year. Maybe you can't. In this situation, we're going to go forward and take out the 50,000. At the beginning of 2009, now you have 760,000. You went from almost 1.2 million a year ago before you took out your money. The market went down. You still took out your money, and now you have 760,000. Now, ironically, I guess not ironically, but if you were all in the U.S. stock market, you would have $650,000, not $760,000. So you have an extra 110,000 because you were diversified. And of course, 2009, we now know, because this is history, the market went up 29%.